Saw this when I was younger when both my parents were working for a real estate development company, JD Construction. They both lost their jobs during the savings and loan crisis, that 4-year down cycle. Historically, one of the most reliable recession warnings that we have. Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. On today's show, I'm going to be talking about the real estate cycle. Every year, I talk about where we are in the 18 and a half year real estate cycle. And one of my favorite resources where I learned about this is The Secret Life of Real Estate and Banking by Philip Anderson. His company, I subscribe to his newsletter. And one of the things that surprised me in this real estate cycle is that it caught me off guard. Now, if you look back through time, going all the way back in the history of this country, the real estate cycle on average tends to repeat every 18.6 years. The interesting thing is that if you look at economics, people say, oh, there's an 11-year cycle, a 7-year cycle. These cycles basically all are inside of the same cycle. And what I mean is the real estate cycle typically has 7 years up. It has a mid-cycle slowdown, which happened during COVID for this. If you go back in the last cycle, it was around 9/11, coincidentally, and then another 7-year upcycle after that slowdown, and then a 4-year reset. And I saw this when I was younger, when both my parents were working for a real estate development company, JD Construction. They both lost their jobs during the savings and loan crisis, that 4-year down cycle. The last 4-year down cycle was 2008 into 2012, and 2012 was probably the best time in the most recent history to buy real estate. But what we've seen is this cycle seemed to have peaked in 2022. And it really didn't make sense to me because I expected the peak to come later. And then you typically see the stock market peak after the real estate or land cycle peaks. And one important thing that Philip Anderson talks about is that the real estate cycle can be tracked by the price of land. Now, this might sound a little interesting to you, but essentially, if you think about real estate, the value is stored in the land. And even the IRS tells you this. Buildings depreciate. They have to be replaced over time. So what is really valuable is the land underneath of it. You can track those land prices that go up. And before we could actually follow land prices and track land prices, you're able to see home builder prices. So if you look at the stock market, you can go and you can look at the price of home builders like Toll Brothers, like Lennar. You can see when they peaked. Those stocks, if you go and look those up in the stock market right now, peaked in fall of 2024. And so we say, okay, well, if we look at home prices, when do they peak? They're still rising, and they are. I mean, but look at mortgage rates today. They're at nearly 7%, right around 6.7% this morning for a 30-year home price. So one of the things, as I look back through this data, and Philip Anderson talks about this as well, which I shared in this week's Saturday newsletter. If you're not subscribed, make sure you go and you subscribe to the podcast on our website, and you'll get our weekly newsletter as well, where we dive into topics like this. But you need to overlay the inflation rate on top of housing prices. And when we do that, what we find is these prices actually peaked in 2022 when you take inflation into account. And this is challenging because inflation has a way of ebbing and flowing actually within the real estate cycle, but we've never seen inflation and interest rates go up like we have in the past few years. So you've worked hard, you earn good money, but you're still trading your time for it, and that gap between income and actual freedom isn't going to close on its own. My new ebook, How to Be Financially Free by 40, gives you a practical framework that I actually use myself to build real cash flow and lasting wealth, not someday in the future, but on a timeline that you can achieve. And it's free. Grab your free copy at nextlevelincome.com. Go to nextlevelincome.com/financial freedom book to get your free copy today. So if you look at where mortgage rates were in the 3% range, sometimes in some cases even lower than that, 5 years ago, they've since doubled. I just mentioned that mortgage rates are in the 6 to 7% range now. Cap rates, if you take a market like Greenville, South Carolina, for multifamily were in the 4.5% to 5% range. Now they're in the 7 to 7.5% range. They've gone up about 50%. You have to overlay the inflation and then put it on top of there. So the real price index is going to be different than the actual price of homes. And if you look at housing prices in the United States, they typically rise at about the rate of inflation. So if we go back and overlay inflation, we find that national home prices actually topped in June of 22, both in nominal and real terms. And these prices split though. Nominal prices kept climbing, but real prices have had a downtrend since then. That's because they've been eroded by inflation. So we've had, low rates, high stimulus before that. Then we've pulled the stimulus back, and inflation has increased. Interest rates have gone up, and this has really had a massive impact on real estate across the board. So again, I dove into this in our newsletter last week, and I'll put a link in the show notes in how you can get that. So that's one important thing that you really need to consider, and that caught me off guard. And as I go back through the data, I can see that. I can say, okay, if we overlay inflation, we do see that housing prices and real estate did peak back then, which is in line with what we saw in the commercial real estate market. But here's the piece I'm watching most closely now. So if you look at the 10-year Treasury rate minus the 2-year Treasury rate, you want to look for when the spread inverts. This has historically been one of the most reliable recession warnings that we have. But since then, it's actually uninverted. So it's now positive again. And that usually happens right before the later stages of the real estate cycle versus the earlier ones. The last time this happened was in November 2006. Before that, March 2000. Before that, March 30th, 1989. And it went down and inverted in July of 2023. So right in line with the timeline that we're talking about. Now, the problem is none of this is going to tell you the exact month or quarter where something changes and where everything happens. But I think what's important right now is that we are in the latter half of that 7-year upcycle. And we need to start being cautious of the types of properties we're buying, the types of investments we're making. And I've been talking about this for well over 2 years. We are fans right now of being the bank. As interest rates are high, we invest in things like private lending, like hard money lending, where we can lend money out at very favorable rates because we're the bank. Our private credit fund, where we're coming in and we're supporting the purchase and financing of stable commercial properties. Also, we're looking at higher cash flow options that are out there, like our up and coming new private equity fund, where we're buying small businesses $1 to $3 million of EBITDA. So this environment and this data is exactly the lens that we're looking at as we go forward through this cycle. We want stable cash flowing assets like value add multifamily, like private lending, like senior housing, like small businesses that are giving us double-digit cash flow in today's market to outstrip inflation and the erosion of our dollar, and still gives us some upside and some stability going forward. So it's a little shorter episode today. If you like it, dive into my newsletter from last week and stay tuned. Make sure you're part of our investor club. Go to our website, nextlevelincome.com, click on schedule a call, and you can get on a call with our team, have a free strategy session no matter where you are in your journey. And also, don't forget to get our free ebook. Go to nextlevelincome.com/financial freedom book. That's /financial freedom book to get your free copy of our ebook today.